Hello, good morning everyone. Welcome to today's webinar. My name is Benjamin, your financials and banking analyst. Okay, today I'll be covering on the Singapore banking sector. I thought it'd be good to revisit this topic again since we're already halfway through the year and it's been quite a number of months since I gave an update on this sector. Alright, so these are the key agendas for today. Number one, net interest margins expanded quite a lot the last quarter, so we have a discussion on if this expansion is expected to remain. Second one will be that the fees and comm, previously I mentioned that is one of the key drivers for growth and we are still very positive on this, so I'll talk a bit more on this. Third one will be on the non-interest income. This portion, I have not really spoken about this before, but I think there are some events that happened last quarter that warrants a discussion on this. And last up, I will emphasize on why we should overweight on the China exposure as well. And then I'll end off with DBS still being on topic, and UOB has been downgraded to neutral during the last quarter results. Right, OCBC is still neutral. First up, let's visit the share price snapshot, right, just to have a better picture. It's a 6-month share price movement. As you can see for DBS at the start of the year, there was quite a bit of short selling pressures from the seller of EM markets, emerging markets. Right, and subsequently, the other downturn is due to the concerns over China exposure that DBS has. And then after the first quarter results came out, you can see that the share price has recovered. But since then, it's been trading sideways. Right. For OCBC, nothing too exciting. At the end of last year, they announced their potential acquisition of Wing Hang Bank in Hong Kong, and that's where we saw the share price having some downward pressures. And subsequent to that, it's been trading sideways. Right. So take note that our call on OCBC has been neutral all along. We haven't changed it. Well, for UOB, it's the opposite of DBS, right? They face some short selling pressures at the start of the year as well, but subsequent to that, you can see that investors seems to prefer UOB, right, because of their least exposure to China. Okay, so year to date, I think it's been up about 15 to 16%, right, since the start of the year for the share price. Okay, so I'll revisit the first quarter results, right, really sometime in April, at end of April, right, so I think this will give us a better context of the discussion that we'll have today. First up, I think last time around, I came up with this waterfall chart as well. So the green color portions show the positive impact on the P&L, and the red color parts will be the negative impact on P&L. So you can see for DBS, the net interest income and the fee income has been doing very well, right? And non-interest income came in as a very huge surprise last quarter, right? Showed a big jump quarter on quarter. The operating expenses increased in line with the top line growth, and so the tax expenses. So overall, it's a very strong quarter. They had 26% up Q on Q. When we look at OCBC, they had a very stellar quarter as well, up 25% Q on Q. Okay, similarly, net interest income and fee income did very well. So did their non-interest income. Right, so for OCBC, I remember that under their non-interest income, they have about 25% coming from Great Eastern Holdings, the insurance income. So insurance did quite well last quarter, but together with the treasury income as well. So then provisions were down slightly, right, but because of an improvement in the NPLs, the non-performing loans. Right, so 25% up Q on Q, a very remarkable quarter. When you look at UOB, right, straight away you can see that the results pales in comparison to the other two peers. Right, net interest income up very, very slightly only, right. Fees and comm was down, in fact, right. So overall, only a 2% growth quarter on quarter, right. A really lackluster performance compared to its two peers. Right, so I'll move on to the first part of my presentation where we will discuss on the net interest margins, on NIMs in short. So previously, if you had tuned into my presentation a few months ago, I came up with this diagram to better illustrate what is net interest margins, because I believe that there are many questions on what this actually was. So if you take a look at this again, I'll go through it just quickly. Your interest income is derived from your interest yielding loans, right? And your interest expense is a cost that you incur for the deposits that you take. And so therefore, these are affected by the external interest rate environment, as well as the pricing power that you have to charge spreads. Okay, so your net interest margins is just your net interest income, which is income less expenses divided by your total loan use, your total yielding loans. All right, so this is sort of like an ROA that we can use to measure. So we look at the two NIMs diagram, okay, net interest margins and NIMs. This diagram was showed in my last presentation where we discussed about the stabilizing of net interest margins over the full year FY13, okay, which is a pretty good sign considering there was a lot of compression of NIMs over the last few years, right? So for the bulk of FY13, the trend was that it has been stabilizing. And then we look at the first quarter performance last year, the last few months, all right, you see that for DBS and OCBC, the NIMs has bounced up about 5 to 6 basis points, right? Whereas for UOB, it's down 1 basis point, right? So after a few more slides, right, I will zoom in to discuss about why this has happened and if this can continue. Right. So with the improvement in the expansion in net interest margins, you can see that for DBS and OCBC, both the net interest income has increased. Right. So net interest income, just take note that for the three banks, it takes up roughly about 50% of the top line. Okay, so UOB, as expected, net interest margins weren't up by much. It was down 1 basis point. So you can see that the net interest income is roughly flat Q on Q. Okay. So now I'll move on to the outlook for NIMs in the midterm, all right, for FY14 and FY15. But previously, our expectation and thesis was that the NIMs are expected to recover gradually in the medium term, right? And as of today, our stand and expectation is not changed as well, but still the same, right? The reason for that is that the pricing of loans, which affects your net interest margins, are usually priced on short-term floating interest rates. So only when your short-term interest rates move, that's when you will see a recovery in your NIMs. Okay, so if you look at the yield curve for SGD, which is highly correlated to the USD side, right? So if you look at this blue line, this is the yield curve as of 1st of Jan 2013. So now it's 12. Last week when I put this out about 12th June, you can see that the curve has steepened quite a lot, and the long end interest rates have moved up by quite a huge amount. All right, but if you compare this blue line with the red line, which is the start of the year for FY14, sorry about the typo for this. Okay. Sorry for the typo for this, but if we look at the red line here, this was the last working day of 2013. You can see that the longer term interest rates have come down a little bit, right? I think one of the reasons for that is that the global equity markets have been rallying quite a lot. So I think investors prefer to park their money in equities instead of lower bond yields. All right, so with this where we have seen that the longer yields have come down a bit. But I think our expectation is the longer yields will be moving up for the course of FY14, okay, by about 40 to 50 basis points. Okay, so again, only when the shorter tail of the yield curve starts moving up, that's when we expect the net interest margins to gradually recover. Okay, so again, when we focus on the short-term interest rates, there are a few key indicators to look at. So one of them would definitely be the status of the US labor market. So for the last few months, we've been seeing more and more positive signs in the US labor market. So if you look at the non-farm payrolls, you can see that the last few months it's been showing a bit of upturn, quite stable and positive signs month after month. Okay, so I think from that we can imply that the Fed Reserve might take on a more hawkish stance, right? So they might possibly keep up the pace and might also speed up the pace of tapering of their QE program, right? So this is expected to end in the fourth quarter of this year, right, for the QE program, and subsequently, I think we can expect short-term interest rates to rise sometime in 2015. Right, expectation is probably the first half of during the midway point of 2015. But if macro data starts looking good, right, it might come as a surprise and possibly in the earlier part of 2015, right, when we see short-term interest rates move up. So in that sense, we can expect a stronger USD as well, right, as more capital outflows back to US. Okay, so that's where we expect the net interest margins to recover when the short-term interest rates move up. Okay. So now let's go back to why the net interest margins have bounced back 5 to 6 basis points for DBS and OCBC. So we can see from what I discussed in the last slide, right, the net interest margins on a sustainable basis usually will only move up when the short-term interest rates increase. Of course, in the first quarter of this year, there was no such case, Right, so the main reason for OCBC and DBS is that because the net interest margins expanded due to the exposure in China, whereas for UOB, they hardly have much exposure there. So that's why you see the NIMs have not really moved. Right, so if you look at this chart, where's the interbank borrowing rates for China, right, since the end of last year until sometime this year before Chinese New Year, that's when you see there was quite a bit of tightening in liquidity in China, right? So that's when the interbank borrowing rates have shot up, and DBS and OCBC have managed to price up their corporate loan use, right, especially on the trade loans, and that is where they've taken quite a few basis points of increase in net interest margins. Right, the other portion, I would say that probably takes about 2 or 3 basis points out of the 5 to 6. And then the remaining amount would be that both have been able to sort of price up the spreads on the corporate loan use. Okay, so if you look at subsequent to that, the last few months, okay, as of due today, but liquidity situation in China is easing slightly, okay, as the government is trying to add a bit more stimulus to the economy to grow it. Okay, so interbank rates are coming down, right, and liquidity is easing as well. So with the interbank rates coming down, I think we can expect that going forward for 2Q, the second quarter of this year, I think that the net interest margins will not be at a 5 to 6 basis points increase from the start of this year that we have seen, right, and for the remaining part of this year as well. So I think we can expect probably on a sustainable basis, probably we'll see a 2 to 3 basis points year-on-year increase for FY14 instead of the huge 5 to 6 basis points. All right. So that's probably the outlook for NIM for the rest of this year. Okay. So after discussing our NIMs, of course, we need to see which banks stand to benefit the most from this expansion. Okay, so the winner in the long run will definitely be the one with the strongest deposit franchise. So what I mean by this is the one with the highest CASA ratio and the one with the highest Sing dollar liquidity. So CASA, just a reminder, is your current accounts and saving accounts, right, out of your total deposits. So you look at the ratio, DBS has the highest CASA deposit ratio, which means that the cost of funding is the cheapest for them as well. Okay, whereas for UOB, they have the lowest CASA deposit. So one thing to look at is that there's a surprisingly low uptrend for the first quarter of this year for their CASA ratios. So I think the banks have been ramping up a bit of a competition to fight to retain their CASA deposit base. So if you have observed from outside, you see promotions going around like the OCBC 360, and then DBS has the all-in-one transaction program as well, where you park all your salary input and savings with them, as well as spending your credit card bills with them as well. So this is some of the strategies they put out to retain their CASA deposit, right, and fend off any competition from each other as well as foreign banks. Okay, so if we look at Sing dollar liquidity measured by loans to deposit ratio, okay, DBS has a higher Sing dollar liquidity, okay, definitely because of their high CASA ratio, and UOB's liquidity is quite tight, right, for Sing dollar, almost really above 95%. So I think that UOB probably will face the worst if there's any form of funding pressure that comes on. Right, so definitely DBS will emerge as the winner when your short-term interest rates move up and your NIM start to correct itself. So one word of caution is that UOB and OCBC has quite a bit of exposure to Indonesia and Malaysia. So Indonesia and Malaysia is seeing quite a bit of deposit competition as well. So that's where I think we can expect some NIM as well as funding pressures from these two markets. Right, so we exercise a bit more caution on these two markets for OCBC and UOB. Right, and management has also reiterated that we need to exercise some caution as well. Now I'll move on to the second part, which is on the fees and commission income. Right, in my last presentation, I have flashed out these 3-year result charts for their fees and com, so you can see that it's quite a strong growth for fee income. So fee income is relatively capital light. Okay, they don't need much capital or book to grow to generate any form of revenue from this. Okay, so which the banks definitely will prefer, since they can take on, they won't take on any risk-weighted assets, so they can retain and boost their capital ratios. Right, so DBS has been growing quite strongly, UOB as well, and OCBC similarly. So if you zoom into the first quarter of this year, you can see that DBS has performed very well for their fee income. OCBC quite stable as well. But UOB overall on an uptrend, but slightly down last quarter. So these three charts are a little messy, but I think I've flashed this before as well. So some of the key areas we look at, actually the three main key areas that we look at is the trade-related fees, right? Where there's a lot of trade flow between China and ASEAN, so it's really good to tap into that. And there's a private wealth management, right? Wealth management activities are increasing in Singapore, and we see a lot of consolidation of wealth management assets that Asian banks are acquiring from the foreign European banks. And also loans related where this is fee income related to underwriting and the rolling over of loans. So we look at OCBC, right? The wealth management fees are very strong. It's coming from Bank of Singapore, right? It's a very good distribution channel for any form of products, financial products that they have, as well as bank assurance, which is coming from contributed by the Great Eastern side. So if we are loans related and trade related, doing pretty decently. Right, so with DBS, the trade related is very, very strong. The trade financing business is strong. They have the strongest exposure to China as well, being able to tap on that. And the wealth management growing very aggressively, right, especially in the last quarter. Yeah, if you recall, earlier part of this year, they acquired SocGen's Asia-Pac private banking assets. So the expansion of AUM and some of the relationship managers, I think going forward, right, I think they're going to do quite well in their wealth management fees too. And DBS, one other thing to take note is that they are currently the top of the league table for RMB denominated bond issuance. So I think that going forward, we can expect that loans related, okay, we see a sharp jump already because of that. I think going forward, we can expect more coming from loans related fees as well as investment banking fees as well. Okay, for UOB, same as well. The wealth management, which is investment related, trade related, and loans related is doing well. But just note that loans related is pretty lumpy, right? Because every time they underwrite a huge loan, that's where they get a huge fee. Okay, so fees and comm is still expected to be a key driver for growth, probably double-digit or high single-digit growth, okay, for this year. And we're pretty positive that this will be a key contributor to the bottom line. So now we'll move on to the non-interest income portion, which I usually don't discuss, but just now earlier on I mentioned that I think what happened this quarter warrants a discussion. So non-interest income is something that is very market-related, capital market-related, right? Usually it's made up of your treasury income, which is coming from trading and so on and so forth. Okay, so for DBS, you can see that it's doing quite decently, right? And this is coming from the fact that they have quite a strong suite of FX-related products, and they have very strong customer treasury flows. UOB is nothing to boast about. Again, for them, they are not very much focused on this portion, right? In fact, they're trying to cut down on any exposure to non-interest income. So out of these three banks, UOB has the least exposure to capital market movements. Whereas for OCBC, their earnings profile is very volatile, not only coming from their treasury trading arm, alright, but it's also coming from the fact that we put their insurance income under this as well. So for insurance, you have a lot of mark-to-market in your portfolio, and that's where you see the earnings volatility. Right, so look at this quarter. You can see that for DBS, they did extremely well last quarter. Okay, huge jump in their non-interest income, which is coming from the trading treasury arm. Right, OCBC did very well from the treasury arm, as well as Great Eastern reversing some of the losses in their portfolio. So UOB with the least exposure, you don't see much movement in this. So we zoom into this, look at OCBC. Their net trading income has been up 43.5% Q-on-Q. Okay, remarkable performance. Whereas for DBS, DBS as well, it came in as a huge surprise, more than 100% increase quarter-on-quarter for the net trading income. Okay. So one of the key reasons that key things that we took away is that both DBS and OCBC we're seeing higher and higher recurring contributions from customer flows, where customers execute trades through them or engage in hedging activities right through the trading desk. For DBS, I think especially for DBS, where you see a more than 100% jump, that's where I think we need to take a closer look. So for DBS, the huge increase in the trading income is largely attributed to the increase in hedging activities that the customers undertake for them. So just a reminder again that DBS has a lot of focus on the trade financing business in terms of both trade loans as well as trade fees. So a lot of these trade activities are denominated in USD, right? So when the yuan appreciates against the USD, the customers will want to come in to hedge off against any of this appreciation. So therefore, we think that their non-interest income, right, their net trading income, right, could possibly start trending downwards if USD appreciates against the China yuan. Okay, so if you look at the during this few couple of months, that's when we see that the China yuan has appreciated against USD, and that's where the hedging activities are coming from. And that's where it has contributed to the net trading income. However, if you look at from February onwards, right, about end of May, all right, that's where you can see that there has been quite a lot of appreciation of the USD against the China yuan. So I think that's where we can expect less hedging activities from customers. Okay, then that's where we derive our conclusion that the trading income might start trending downwards. However, okay, again, just to remind why non-interest income is a wild card, is that the fact that you see this currency pair can trend either way. All right, in the last 2 weeks, 1 or 2 weeks, all right, you can see that USD against CNY has swung the other way. Right after China has reported their trade surplus almost doubled, and PBOC has been increasing their yuan fixing. All right, so with the appreciation of yuan against USD, this could also mean that hedging activities might start increasing again in the next quarter. All right, so that's it for non-interest income. Now I move on to the last key theme for today, which is overweighting on the China exposure. DBS has been our top pick for quite a while, and our stand has not changed, neither has our call on DBS. But we still prefer DBS, even though there were a lot of short-selling pressures at the start of the year because of the China exposure. But we believe that asset quality concerns that the investors have are largely overblown and overdue. Where we met up with the head of Global Transaction Services for DBS sometime in March. And the key thing that we took away is that DBS has a really robust risk management system, and as well as their very strong DD that they perform for underwriting of trade loans, right? And one of the key mitigating things against this concern over China exposure is that the majority of the customers are very large corporates or state-backed. Okay, and the trade loans that are underwritten are usually very, very short in nature. Okay, because of trade loans, bulk of them might be working capital type of loans as well. So the tenor is very short, right? You're looking at about an average about 4 months, right? So with a shorter tenor, the risk of default and credit risk is much lower as well. And about more than 70% of the loans are either backed by one of the big 4 banks or cash backed, right? If not, DBS will not conduct any form of business with them. So I think we can infer that the asset quality and credit quality is really very much benign, and as the risk of default is low, so we don't expect any spikes in NPLs to come up, right? This was what we expected in the previous quarter. And after the results have come out, right, DBS did not see any form of non-performing loans increasing for their China book and Hong Kong exposure, right? In fact, their results were extremely good. You've seen at the start up 25% Q on Q. Okay, so we look at the share price movement. All right, at the start of the year, it's no surprise that investors prefer UOB because UOB is the proxy to the ASEAN story play against DBS, which is more of the China play, right? But after the situation has stabilized and DBS has proven that their China exposure is nothing to worry about, the share price has still been trading sideways. Okay, so we expect this deviation from the fundamentals to reverse going forward, right, for UOB and DBS. Right, so we expect that people will start to appreciate the potential outperform for DBS. Okay, and UOB's valuations are looking a little bit stretched really at this point of time. So last up, some of the key things that we expect people to focus on for FY14. Right, first up, where the NIM, the interest margin story has come back to play. So for the rest of this year, we only expect a 2 or 3 basis point increase year on year, right? And just watch out for any form of funding pressures that we might have, as Singapore system liquidity is looking a little bit tight now. For loans growth, the banks are gunning for moderate pace, so we expect about high single digit to low teens. We expect high single digit to low teens, okay, for loans growth. Okay, and we expect this also depends on their regional franchising strength as well. For Singapore, loans growth is looking to be not much room for growth, right? As you know that there's a bit of a pressure coming from the mortgage books as well. For fees and comm, banks are expecting double-digit growth. Okay, we also expect this strong traction to continue. Okay, for costs, we expect it to increase a little bit as banks are investing a bit more, as well as staff costs is expected to increase too. Okay, asset quality, like I mentioned before, is expected to remain benign. Macro data is looking quite good. Okay, so I think NPL ratios are at all-time low, and the fact that the loan books growing is from the short-term trade loans, alright. I don't think there's much default of that, risk of default from that. So I don't think credit quality is going to worsen. Okay, for regulatory changes is nothing much. So for ASEAN, I think just be a bit more cautious. The political situation in Thailand is still a bit uneasy, although it has been looking better in the last 2 weeks. Okay, but still quite rocky. So I think overseas subsidiaries like UOB might be affected from this. And then for ASEAN currencies, if there's any form of depreciation, right, I think we can expect lower loans growth and fees and comm from their overseas contribution. So I'll end off the presentation with this. Okay, so UOB is still a topic, accumulate rating. Okay, just take note that our rating and call and valuation has not changed since April. So DBS is accumulate at $19. Okay, it's highest exposure to Greater China, has the highest CASA deposits, so that's when they can take advantage of rising interest rates. And PB valuation is on a relative basis is still very much lower than its peers, despite equivalently as good or better ROE profile that we can see. Okay, so relatively undervalued compared to its two peers. For UOB, the fees and comm and overseas contribution is quite strong, but we have downgraded them to neutral in the last quarter because of their valuations been running a bit high. Okay, so it's looking quite stretched. Okay, it's really overshot our target price, so that's when we downgraded them to neutral, as we see little upside to its performance for the rest of this year. Right, for OCBC, it's been trading sideways all along, and OCBC has always been on neutral call for quite some time. So you can see that there's not much difference between the share price and our target price currently. So for OCBC, it's a bit of a pity as their banking operations are actually quite strong. Their bank assurance, which is the banking together with the insurance model, is quite strong. And they have Bank of Singapore as well to generate wealth income and act as a distribution channel for them. Okay, but the only thing is that earnings profile is still a bit more volatile, but I think the insurance side will start doing well once the interest rates have moved and stabilized for a while. Okay, so the only key thing as of now is just that there's a lot of uncertainty around how much equity OCBC is looking to issue to fund their Wing Hang Bank acquisition so as to fulfill their capital ratios. So I think that once we have a bit more clarity on this, this will act as a re-rating catalyst for OCBC. Okay, so with that, I'll end off my presentation on the banking sector. So now let's welcome any questions. First up, I have a question on I think the previous slide on the regulatory changes. Okay, so for the banking community, the focus is currently focus more on the liquidity coverage ratio instead of using a loans to deposit ratio. So to give you a bit of background, your loans to deposit ratio was traditionally used as a measure of liquidity because it's how much loans you give out versus how much deposits you take in. Okay, I would say that at this point in time, most people feel that LDR is no longer a key measure of liquidity because traditionally, whatever loans you give out depends on how much deposits you take on. So if it's more than 100%, all right, you have a shortfall of liquidity. Okay, but now that a lot of the loans that's being issued by the Singapore banks are trade loans and very short-term in nature, it's much easier to match off the duration profile by using commercial papers, for example, which are very short-term in nature, 3 to 6 months. It has a much better matching profile to the short-term trade loans that you give out. So because of that, it's not captured under the LDR. So if your LDR runs above 100%, it does not mean that the banks have any form of liquidity pressure, okay, shortfall liquidity. So instead, under the new Basel III requirements, they are supposed to fulfill this liquidity coverage ratio, which currently MAS is still finalizing on the final ratio for this. So this is more like within a certain period of time, how much liquid assets you have that is able to cover a certain form of denominator, right? So the question also on which bank has the greatest exposure to the APEC region. For all three banks, I think DBS has the highest split to Singapore, followed by China and Hong Kong as well. Right. For OCBC and UOB, both about 50-50 in terms of Singapore versus ASEAN markets. Right. OCBC has the highest exposure to Malaysia. I think about 20% is coming from Malaysia, another 15% coming from Indonesia. Okay, for UOB about 40 to 50% Singapore, another probably 25 to Malaysia, 25 to Indonesia. And for UOB, they're looking to expand their overseas contribution to beyond 50%. Okay. Four banks are your ABC, Bank of China, ICBC, and China Construction Bank, CCB. Yeah, those are the four banks. And yes, they are backed by the government of China. So for DBS, they generally only deal with customers that have that the other counterparty is backed by these four banks. If not, they generally don't want to deal with them. Reviews for the SGD.
SGD against USD.
Sorry, I have a question on do you anticipate USD to strengthen further in the future? I think definitely this is in the long run, looking at 1 to 2 years, I think USD will definitely strengthen in the longer run, right? Since that if you look at the longer term yields, it's been increasing as well over the course of last month. And once the short term interest rates move up, I think I expect a lot of capital inflow to go back to US, and that's where we expect stronger USD. Alright, for Sing dollar, yes, there's a bit of a positive correlation, but SGD is still pretty much tagged to a basket of currencies. So it really very much depends on how the economics actually work out. Currently, we don't really have a stand or rating or view on SGD. Yeah. I think the question on Singapore launching overnight yuan liquidity facility from July onwards, how will it help the stock market and bank? I think with the increased overnight yuan liquidity facility for Singapore, Singapore is really one of the key offshore CNH clearing that we have outside of China. I think with the overnight yuan liquidity facility, we can expect more offshore clearing to occur over in Singapore, especially for the stock market side. And for the banks, I think we can see more trade loans being underwritten overseas as well, okay, because it's easier to get access to offshore RMB. Right, so definitely a positive impact. Okay, but I think one key thing to look out for stock markets as well is there's a direct access agreement for Hong Kong Exchange and Shanghai. Right, so this might take up a bit of market share from the Singapore side as well. Okay. Right, for Kaplan, our property analyst is currently not in Singapore today. Maybe next week he'll be back. It'll be good to revisit it as well, as we are going to start covering Kaplan in July. So I think this question probably can post it next week and we can get quite a good answer. Thanks.
Hi, good morning. Just a quick update on the markets. So, update on the US market. The update for the US market is as follows. There seems to be a minor correction in play right now. Okay, so at this point in time, we can say that a minor correction is probably in play. Whether it morphs into a major one is still not sure yet. But in any case, for the S&P, the very high probability target at this point in time is between 1860 and 1900. Okay, so let me repeat that. The high probability downside target for the S&P is 1860 to 1900. That's because of a confluence of Fibonacci ratios. It's actually a confluence of two moves. So anyway, this is the short-term target. Also, there is the daily MACD is about to cross as well. So what we can say is it's a minor, could be a minor correction in play right now. Now, for the other markets, emerging market and even Singapore, we mentioned the last time that so long as the US does not go into a major correction because of relative value, good valuations, that the emerging markets can all rise, and that's basically what's been happening. So the emerging markets have all outperformed Singapore and the BRICS and EMM. So essentially, we think for the emerging markets right now, most of them, Singapore market, the BRIG and EM, all of them are right now on resistance levels. They're all challenging resistance levels right now and consolidating on them. So we maintain the stance that as long as the US does not go into a major correction, there's a chance for these markets to actually go higher a bit slowly. Okay, so right now the US is going through a minor correction, but it's still in question whether it will morph into something bigger. And the high probability downside target for the US market is 1860 to 1900.
Okay, just give us a second, and we'll have some comments on China and Hong Kong. Okay, for question on OCBC's daily share buyback, okay, I think it shouldn't come as a surprise that it's enhancing the shareholder value of buying back treasury shares, right? As I mentioned before, we're not sure how much equity OCBC is going to issue to fund their Wing Hang acquisition. My tendency is that, of course, if you push our share price, the amount of shares that you issue in the form of rights issuance will be less, so there's a less of a dilution to the shareholder value. So I don't think that we can see. I don't think that this much of a surprise that they are buying shares back on a regular basis. And also notice that for the start of this year, both three banks also brought back in their scrip dividend policy as well, so to protect the capital base. Okay. Testing.
Hello, this is Lindsay, macro analyst for the China, for the Asian side. So there's a question on your view of China and Hong Kong. Basically, for China, concerns of slowing growth in this economy has eased as both official PMIs edge higher. Trade account balance, trade account improve as well as their inflation rebound, and some of the inflation, some of the deflation concerns eased, as well as signaling more domestic demand for that particular market. Then there are actually followed with a series of targeted stimulus measures announced over May. These actually will also promote growth within the market. The People's Bank of China said that it would reduce the required reserve ratio by 0.5% for banks that mainly lend to small businesses and rural borrowers. This new measure, which comes into effect on June of 16, which is today, is actually aimed squarely at small banks engaged in proportionate lending to agricultural and small firms. This measure will inject liquidity into the system while controlling credits being channeled into speculative investments in the housing markets as well. So the government also plan to speed up railway and public housing construction and tax breaks for small businesses. There's also a fund of 2.8 billion yuan being set up to boost economic development in the country's impoverished region. So all these measures should be able to underpin China's growth at above 7%. Yeah.
Okay, there are no last questions. I think it's time for us to end off the weekly webinar. Thank you for attending, and we hope to see you back again next week. Right, thank you.